Hey friends, so I've been adding a brand new position to my portfolio. As soon as I started buying this position, it fell in share price. Have you had that experience before in the stock market? Put it in the comments below. I'd love to hear from you. It's so funny. This is Meta. It's a tech stock. You wouldn't expect it from PPC Ian, although maybe you do if you've been following my videos. I will link in the pinned comment. I initiated a position in Alphabet, ticker GOOGL, earlier this year as well. Now, I had the same experience with Alphabet. When I started buying, it was falling in share price. I kept averaging down for a better overall average cost of shares. And now, on everything that I have with Alphabet, I'm up about 58%. How wild is that? Now, I don't expect the same with Meta. It could fall a lot more from here, but I'm still building my position and I'm excited to average down. This one is a very long-term yield on cost investment for me. Yes, I am investing for the dividend. I want to start the video today with my thesis and with some high-level thoughts, and then I will get into the numbers. What is my thesis with Meta stock? Ian, why are you doing this? Check it out on the screen in front of you right now. I have a number of points that I want to cover. Number one is that I am future-proofing my portfolio. Everyone right now seems to be down on Meta because their CapEx or capital expenditures are coming in higher than a lot of analysts wanted. And I think people are thinking, are they squandering this CapEx or is it really going to yield great results in the future? Look, I am future-proofing my portfolio by investing in Meta because I believe it's a great dividend growth stock of the future. Yes, they now pay a dividend. That is why I am in the stock. And they increased the dividend the last time by 5%. We'll see if they increase it again. But 5% year over year is not a bad start. But I love all the CapEx because the CapEx, this is investments in new infrastructure, new servers, new sources of energy that are going to power the future of AI for Meta. And so I see this as a big AI player in the future. And I believe in the investment over the long term. And I believe it's a hedge against my otherwise more conservative classical dividend stock portfolio. As you can see on the screen, I have a number of points and fun thoughts to explore. The next one is I believe it's a great dividend growth stock of the future. I already touched on this, but I'm really in it for the dividend and for yield on cost. I know I mentioned, hey, I'm up 58% on Alphabet, and I'm excited about it. It feels good. I can't do anything with that 58% because I don't plan to sell, but nonetheless, it feels good to have the capital appreciation, and yes, it does help. But overall, I'm really in this for dividend yield on cost, and I don't foresee that I'm going to have a ton of it in the first 10 years, but maybe 20 years out or so, it will have a lot of yield on cost. Hey, yes, I am late. Why am I late to this? Because I waited for the dividend and I waited for a good share price, a value. I'm going to get into this later. I think Meta is trading at a value, but hey, better late than never. Let me be kind of the living example here on YouTube that, yeah, I am a little later to the game on some of these tech stocks. And it is kind of funny given my background because I spent so many years of my life working in the tech industry, working in digital marketing. And Ian, why didn't you invest sooner? Hey, I'm a dividend stock investor. I'm investing for cash flow, massive cash flow that's going to get me to my financial goals probably about 6 or so years from now, right now. And so that's how I invest. That's why I have historically skipped these stocks. But look, better late than never. Check it out on the screen. I have so many thoughts. I love this one, and that's why I highlight it in yellow. I have a lot of tickers here. These are all stocks I own. I own the SIN stocks, some of my best performers of all time from a massive dividend cash flow standpoint and capital appreciation unrealized as well. Altria, British American, Philip Morris. I love the fast food and everyday indulgences too, like McDonald's and Starbucks. McDonald's has been one of my better performers in my portfolio. Starbucks, it hasn't been performing as well, but I'm going to do an update for you all on that one sometime soon. Snack food. I own PepsiCo. Now I own Meta. Meta, what are they really capturing? Scrolling and kind of attention, time span. Here's what I love as an investor, and this is my thesis in Meta. I like to invest in those companies that are part of the habits of society, everyday indulgences, recurring patterns. I don't want to invest in companies that are one and done. I don't want to invest in companies where, hey, the consumer buys something and then they leave. No, I want to invest in those companies that become a critical part of the consumer's life, that are part of those everyday habits. With the digital revolution and with us having these smartphones these days and these apps like Facebook and Instagram, the scrolling, it is now part of life for so many people. And I want my piece of that as a dividend stock investor. That is probably the pinnacle of my thesis with this stock as I move forward with it. Now check it out on the screen, a few more thoughts. So I'm aiming for about 0.5% allocation to this stock in my portfolio, maybe as high as 1%. And now that can grow over time because the gains from this stock may be outpaced over time. I just want some exposure to the great dividend growth stocks of the future, but I don't want to depart from my classical strategy too much because look, I need cash flow that can pay the bills now. Hey everyone, I started buying and so the stock corrected. I'm okay with it, even if it corrects another 50%. Hey, that's what happened with Google. I don't know how much it corrected, but it was quite a bit after I started buying, and now I'm up about 58%. So that is all good. It's really fun to buy these types of stocks, honestly. It's kind of exhilarating because I spend so much time on meta products like Facebook and Instagram. I spend so much time with it on alphabet products like YouTube right now. And so it's really fun to own a piece of these companies that I invest so much of my personal time into. But honestly, after that, it's kind of funny as a dividend investor to buy these because it's like, hey, okay, now what? But with my dividend stocks, I'm receiving dividends every quarter typically, or with some of them even monthly, or with one of them in particular. And so it's just so different than what I'm used to, but I love it. And it plays a critical role in the portfolio. Now let's look at some metrics. As you can see on the screen in front of you right now, I have a comparison of Alphabet and Meta. I wanted to do this just to kind of show, hey, these are the two tech stocks that I'm kind of familiar with now because I've been analyzing them a lot these days. I'm going to link to my Alphabet analysis from earlier in the year in the pinned comment below. But what you see on the screen is just kind of side by side the metrics I like to look at. I'm up 58% on my Alphabet shares. My average cost is $180.45. But on my Meta shares, my average cost now is $700.92. I'm down about 14%. So hey, I'm down. Meta is down 24% from the 52-week high. Alphabet only 3%. On a forward PE basis, I love Meta, and I highlight it because now the 2026 forward PE is at a 20. Given their revenue and earnings growth, which is so rapid, I think that the PE of 20 illustrates that the stock right now is undervalued. Now, Alphabet on a forward basis for 2026 has a PE of 25. I do not highlight it because I think it's fairly valued now for their level of growth. But Alphabet, hey, I wouldn't mind even buying more shares at a fair value price because Alphabet is such a great company. But it's not, I would say, on sale right now the way I see Meta. Now, Meta pays a dividend of 0.35%. Alphabet is at 0.29%. Both of them have very low payout ratios. Meta's is just under 9%. Alphabet's is just under 8%. Both of them just increased their dividend for the first time ever, 5% each. After initiating their dividend, the first increase was 5% for each of them. Both of these are multi-trillion-dollar companies. Meta is $1.5 trillion. Alphabet is $3.45 trillion. And so that's kind of a comparison of the two companies. Both of these, I believe, are some of the best companies in our world right now, and I'm excited to finally own them. I was waiting for the dividend, and I'm happy to now be a shareholder in both of these. And am I adding Alphabet now? Probably not, unless the stock corrects a little bit, although I think it's kind of at a fair value, not a discount. But Meta, yeah, I'm averaging in. And I share my trades on my Patreon Backyard and Corner tiers. I will link to that in the pinned comment below. So a few things. Why is Meta stock down? Well, it's down because they just announced their earnings recently for Q3 and the street didn't like them. As you can see on the screen, I have a few highlights here. What did the street not like? They did not like the fact that they had a one-time non-cash income tax charge of about $16 billion related to their accounting and their taxes and the big, beautiful bill. It was non-cash though, so I don't know why the street really reacted so harshly to this. I'm going to do a overview of the non-GAAP numbers a little bit later, but GAAP numbers, generally accepted accounting principles, don't look so good because they do take into account this non-cash income tax charge, and it affects the EPS. CapEx, I think this is really what the street didn't like. They're saying for 2025, CapEx, capital expenditures, are coming in between 70 and 72 billion versus a prior outlook of 66 to 72 billion. Basically, CapEx is coming in strong. And I think the street is wondering, hey, are they putting this CapEx to good use, or is some of it getting wasted? The market did not like these results. I really loved them because, again, why do I invest in Meta? I invest in it to future-proof my portfolio. What will future-proof my portfolio? The very CapEx that they are investing in. So, hey, Meta, keep up with the CapEx. I like it. But check it out. As you can see on the screen, this is an overview of some of the metrics from their earnings release. And these are some really cool trends. You can see that their family daily active people, or DAP, we're up 8% year over year. So basically, users on Meta are still growing, even though Meta is so big already. That's crazy. Ad impressions are up 14% year over year. Average price per ad increased 10% year over year. Revenue for a mature $1.5 billion company trading at a PE of about 20 on a forward basis is still growing revenue at 26% year over year. That's why I'm investing in this. This is a dividend growth stock of the future. What are they growing? They're growing their revenue. They're growing their earnings. They're growing the business. Ultimately, they're going to grow the dividend, I believe. What's going to happen 10 or 15 years from now? The dividend will have compounded so much that when I look at my dividend yield on cost, it's going to be looking pretty good, in my opinion, especially 20 years from now. But as you can see on the screen, I want to keep going. Also, we can see that costs and expenses are up. One thing I did not like, and maybe one of the reasons the street didn't like their announcement and the stock's been trending down, is, hey, costs and expenses are up. I don't even know if this includes CapEx. I don't think it does. It's up 32%. So costs and expenses are outpacing revenue growth, which means margins are shrinking. And so that's something to keep in mind. I don't like that. CapEx, I'm fine with it. Capital return program. They're doing share repurchases. I like that. Reducing shares is good because it's always going to increase the value of each share that is still outstanding. It's going to make it easier for them to grow EPS. And if they see value in their shares, that's great. And I love that they mention the dividend here. We finally have this tech company actually mentioning the dividend on page 1 of the earnings release. Gotta love it. Cash equivalents, marketable securities are strong. Also, I like this that the headcount is growing. So this is a business where, hey, they're growing the headcount. More people are working there, 8% year over year. And so there are opportunities for careers at Meta. That's pretty awesome. So what I want to do next is I want to go into the income statement because this is going to show why some investors freaked out because of the non-cash charge, because we're going to look at the GAAP income statement, generally accepted accounting principles. As you can see on the screen, check it out. Now, what you see here is the revenue first. Revenue is growing. It's up a lot year over year. You have the 3 months and the 9 months. They're growing revenue about 26% year over year. You can see they have cost of revenue, and you can see that that is increasing as well. Marketing and sales increasing as well. General and administrative increasing as well. The total costs and expenses, you can see there on a percentage basis, as we saw in the prior screen, it's outpacing revenue growth, which means that the operating margins are shrinking compared to year over year. But hey, I imagine these are numbers that will fluctuate over time. And I also imagine with a company like this that it probably makes sense to invest a lot of money in R&D, marketing and sales, general and administrative as well. Okay, so I think where people are really starting to freak out with this thing is if you look at this line, it has provision for income taxes. We go from like 2 billion to like 18.9 billion. That's where that non-cash charge is showing up. And it's throwing things off because the net income drops all the way from like 15.6 billion down to like 2.7 billion. And investors don't like it. And the GAAP EPS, earnings per share, is dropping. But again, remember that huge $15+ billion charge was non-cash. And so what I want to do in the next screen is show you their non-GAAP reconciliation. Check it out. And so it's really important to keep this in mind, the way numbers are these days. And I'm sure some of the accountants watching can put in the comments below more insights than I'm able to offer. I'm not an accountant and I'm not sharing investment advice, just sharing my personal journey for fun and entertainment. But we have some accountants that watch here. Please put in the comments below why you think that this non-cash charge, if you think it was a big deal, I'd love to know. But let's look at the reconciliation, and what you see here is it all starts with the GAAP revenue. Great, way up. I'm just looking at the 3 months, keep it simple, but they have the 3 months and the 9 months, a comparable year over year. Here's where things get interesting towards the bottom of the screen. We have the net cash provided by operating activities. What have we got? In 25, we've got 29.999 billion. In 2024, we have 24.7 billion. So clearly, they're growing the net cash provided by operating activities very well. We have purchases of property and equipment. Well, that is way up year over year. We go from 8 billion in 24 to 18.8 billion in 25. This is throwing things off yet again. And I think this is one of the reasons the street is a little spooked here, is they're making huge investments in property and equipment. This is the CapEx. You have some principal payments and finance leases and free cash flow, which is down. So we go from 15.5 billion free cash flow to 10.6 in the 3 months ended September 30th. And obviously the reason that it's down is from the CapEx, the purchases of property and equipment. But I want to draw your attention again back up to the net cash provided by operating activities is 29.999 billion versus 24. Maybe this is just an easier way to look at it, in my opinion, than the traditional income statement, because it just gives us a better sense of where things are trending from a kind of numbers standpoint, from a real practical business standpoint, not looking at the non-cash tax charge. So we can see that the operating income is going way up, but we can also see that free cash flow, hey, it is down because of the huge CapEx, but I'm a fan of the CapEx. Put in the comments below, are you a fan of Meta's CapEx here? Are you not a fan? Let me know. I'm a fan of it because I'm investing in this one for the future, and I think they have to get ahead of this AI curve because they are competing with all of the biggest and best companies in the world, and this is their chance right now. And so I like what they're doing. But I like looking at it that way, the non-GAAP numbers. It just helps me better understand the business, and I'm happy with what I'm seeing. What I want to do next is show you the balance sheet. Check it out. As you can see on the screen, this is a statement of their balance sheet. And what I really want to point out here is I kind of like what I see. It's just a clean balance sheet. I don't really see any problems here. They don't have a lot of debt. They have a lot of assets. We can see they have like $300 billion in assets. And this is up year over year. I'd say the main reason it's up year over year is the property and equipment. It must be all that CapEx in there. You can see that cash and cash equivalents are a little down, probably because they're purchasing all that equipment. Marketable securities kind of flat. But anyway, the assets are pretty strong. But when we scroll towards the bottom of this, you can see that the liabilities are up. They're up from like 93 billion all the way up to maybe $109.7 billion. And why are the liabilities up? It kind of looks across multiple categories. I don't see anything sticking out too much. And most importantly, I don't see a whole ton of long-term debt. So overall, what I would say about this balance sheet, to me at least, and one of the reasons that I like investing in companies like Meta and Alphabet for that matter, is the balance sheets. They're just really strong as compared to some of the more traditional, kind of more capital intensive companies that I own, maybe in the CPG space or in the utilities space, for example, a lot of these companies I own sometimes, they've got some debt. But these tech companies, what's so interesting is they're just free cash flow machines. And yes, they're plowing a lot of that back into CapEx, but the balance sheet, still pretty good. And so I like tech companies for that. And I like the fact that they can just build this platform and then the marginal cost of scaling it is next to nothing other than this CapEx they're doing right now. But with a lot of the other companies I own, hey, the marginal cost of scaling a utility company, for example, it's a lot. Or even the marginal cost of producing more food for a CPG food company. I talk about these a lot on my Patreon, which I'll link to in the pinned comment below. That's expensive. And so sometimes those companies, the margins might not be as good as with a tech company like Meta or Alphabet. And certainly some of them, their balance sheets, they're not always as clean as a Meta or Alphabet. But put in the comments below, what do you think? Are you a dividend stock investor like me, kind of old school DGI, dividend growth investor? And if you are you adding these tech stocks to your portfolio? And if you are, what are the reasons? Put in the comments below. I would love to have a discussion. I would love to hear what you think. And before I go, if you enjoyed the video today, please consider subscribing to my channel. It really means the world. And before we go, in terms of a full disclosure, I am long Meta, ticker META. I'm long Alphabet, ticker GOOGL. I am also long the Sin stocks, Altria, ticker MO, Philip Morris International, PM, and British American, ticker BTI. I'm long those restaurants I mentioned, McDonald's, ticker MCD, and Starbucks, SBUX. Also, I'm long the snack food company, PepsiCo, ticker PEP. I own those stocks just mentioned in my personal dividend stock portfolio. Before I go, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed financial advisor. I'm just sharing my journey for fun and entertainment. Please consult your licensed financial advisor before making any financial decisions. I'm just sharing my journey for fun and entertainment. It's possible to lose money in the stock market. I have all my disclaimers in the description below as well. Thank you for watching. I'll see you in the comments below, and I'll see you in the next dividend stock investing video.